Hi, I'm Jackie Benson, an economist with Wells Fargo. I'm here today with my colleague Charlie Dougherty to discuss our latest monthly economic outlook. Now Charlie, we haven't made substantial changes to our outlook since last month, but one change we did make was to revise up our near-term expectations for real GDP growth. Can you talk a little bit about what went into that decision?
Yeah, so the U.S. economy continues to hold up remarkably well. The incoming data for the third quarter point to real GDP expanding at about a 3% rate. Now that's up a little bit compared to the second quarter and overall represents a pretty solid pace of growth. Now we are expecting the limiting effects of restrictive monetary policy to continue to make its way through the economy, and that means that growth should slow down a little bit. But overall, growth should remain fairly sturdy. If you look at what's been happening with the U.S. consumer, spending continues to run at a very strong rate. And there's good reason to believe that that trend will continue. So we recently received some new revisions to the income and spending data. And how it shakes out is that income growth over the past year has been a little bit stronger than what we had first thought. So the saving rate was revised up. And that saving rate moving up means that households are now in a little bit better financial shape than we first thought. So this means that consumer spending should continue to be fairly resilient, and so should overall GDP growth. So Jackie, we recently received some positive news on the labor market as well. So could you walk us through those developments?
Absolutely. So the recent labor market data has been quite encouraging. The U.S. economy added over 250,000 jobs on net in September, and the job gains in the prior 2 months were actually revised higher. At the same time, it appears that the household survey is catching up to that strength we've seen in the establishment survey for some time now, with the unemployment rate declining for 2 months in a row. It currently sits at 4.1%. That's still, healthy for the U.S. in historical context. With all of that said, the labor market is healthy, but the direction is still pointing toward cooling. So we still see that downward trend in job openings through the monthly volatility. And the overall balance of the labor market is more or less back to where it was right before the pandemic, if not a little bit looser than that. If we go to the other side of the Fed's mandate, inflation remains contained on a slow downward march. So price pressures continue to recede through some monthly volatility, and a lot of that is driven by firm inflation in shelter. Now, we did see shelter inflation ease in the September Consumer Price Index, and we expect more moderation in the months to come, kind of echoing that slowdown in private sector rents that's been going on for some time now. Now, let me throw it back to you, Charlie. With all of that said, and given the renewed resilience in non-farm payrolls, what implications does this have for our Fed call?
Yeah, so if we zoom out, the Fed did go ahead and reduce the federal funds target rate by 50 basis points at the September FOMC meeting. So they've started the process of easing monetary policy, and we're expecting this to continue. So right now we anticipate that the Fed will cut rates by 25 basis points in November, and then by another 25 basis points in December. After that, they can become a little bit more cautious and wait to see how the effects of the monetary easing process are going. So what we're looking for in 2025 is 5 additional rate cuts that are spread across the year as a whole. So they want to get interest rates back down into neutral territory, and the effect there should be a more energized pace of GDP growth moving forward.
Thanks, Charlie. And from all of us here at Wells Fargo, thanks for tuning in to another monthly economic outlook. We'll see you next time.